everyone, this is Eckstein with MVP Realty and Tyler Esposito with Movement Mortgage. Today is August 4th, and we come back with again another market update and mortgage update for Southwest Florida. But I decided to do a little bit something different today. So I'm like a big fan about the webinars, and I'm participating like every 2 weeks on economy webinar update from top economists and on things going on with unemployment and all things, you know, that it's really to the bottom of our hearts right now with all this economy and this pandemic. So anyway, I decided to include today a couple extra the information that we can all share with you, and so you kind of know what's going on. So Tyler, let me share the screen, and we can actually start the, okay, one second, just bear with me. Okay. All right. So this one is the first quote actually I would like to share, that this is from the Morgan Stanley chief global economist, that we said that we believe this will be a sharper but shorter recession, and recent upside supplies in growth data and policy action have increase our confidence in that we will have a deep V-shaped recovery. So that's kind of positive. I mean, I'm really looking forward to that, right?
Yeah, it's definitely positive, and I think we're starting to see that already. Obviously, no one has a crystal ball to see what is going to happen in 12 months, but I think we're starting to see that, and we're going to kind of talk about those numbers that we're already seeing that are indicating more of a V shape.
Absolutely. And this is the next chart that we'd like to share. This is, you kind of can see the consumer spending. We start from January to July, and you can see that we kind of was pretty flat, right? January, February, March, and then we really, you know, got to the deeper numbers of, unfortunately. But as you can see on a positive note to that, we actually start recovering, you know, fairly pretty well, right? So the this one chart that we would like to share with you is actually the total spending by the industry, and you can see some industries, you know, they're doing fairly well, and some, unfortunately, it is what it is, and you know, it will take some time to recover. But if you know, in those industries like groceries, geez, I mean, they've been doing pretty well.
Yeah. Definitely, people not eating out as much, but even from this graph, you can start to see that you're seeing that bottom in, you know, let's call it May, and then a nice sharp recovery coming back for certain industries. And like you said, some industries are going to lag behind a little bit, but in general, everything is going up. So we'll see how that trends over the next couple months.
Absolutely. And even like think about industries like restaurants and hotels, they start thinking like more outside the box, like, well, maybe we cannot have 100% capacity inside, but we can do the outside takeout. I mean, there's just, you know, there's just all these industries, all what they do in towards recovery is trying to innovate themselves so they can, you know, do differently and better and recover as quickly as that would be possible, right?
Yeah, absolutely. You're seeing people diversify their services so that they can offer more to their clients. So it's good. And I think longer term, that's going to benefit those businesses after we get through this. You know, when we talk 24 and 36 months out, I think it's going to make them very strong.
Yeah, no, I agree with you 100%. This is actually a pretty exciting chart. I was like looking, it's like, wow, I mean, that's really exciting. I mean, this is actually housing market recovery index, and you can see that it really depends on the 4 different components: demand, supply, price, and time on the market. And you can see that dip that we had, but take a look where we're at right now, and this is based on February baseline. I mean, it's pretty encouraging and really, you know, it put a lot of hope, let's say this way.
Yeah, definitely. And I know that we both are seeing this in our day-to-day business of, you know, we're starting to see a lot more people putting applications in and starting to buy more homes. So we're definitely seeing that recovery, especially in the Southwest Florida area.
Yeah. So this is something that nobody wants, I guess, to talk, but, you know, it is a painful, right? But, you know, it's unemployment. I mean, it's just, you know, unfortunately, gosh, it's just so many people being really devastated with this pandemic. And you can see the unemployment applications, filings really, been rising. And this chart indicated is actually 51 million right now currently that we have all total application. That's not means like, oh my gosh, it's 51 million people unemployed. No, it's 51 million actually filed for the unemployment. And this number, 16.2, is indicated that how many people is actually receiving, and this is based on July 11, receiving their unemployment. So the number is still there. It's just, we just have to, in my opinion, I'm the type of person, I need to know the numbers. Like for me, it's so important to make those type of decisions. And, we've been talking last time, Tyler, we said that, yes, there's 16.2 million people is actually receiving those benefits. And, but, like majority, like, I don't remember like where we said the numbers because I don't have a chart, but we said the majority younger people actually had that, I think like 29% of actually those unemployment for the younger population. I think like 19.
Yeah. If we looked at it as a percentage of the population, there was a large percentage of the younger generation. I think it was 25 and under that was unemployed. That was a larger percentage of unemployment. But when you got into the 35 and 40 age groups, there was a lot lower unemployment rate. So that, although you don't want to see anybody out of work and you want everyone to have the opportunity to work, that does show that there is a, I guess, not a discrepancy, but there's a difference between age groups of unemployment.
And there's no doubt in my mind that there's, gosh, just so much work needs to be done. I mean, 16 million people unemployed. I mean, it's not fun. I mean, it's really, I'm just hoping that we can recover this as quickly as you can, because I cannot even imagine how many families being affected by this pandemic. But I just thought that we guys should know the numbers. I mean, the numbers is important. So anyway, let's, so this one is, this is actually was quite interesting chart for me, because it's interesting that unemployment rate, you would think that will go kind of along with the home sales, but it's not, really not, and we look historically, you can see the number one is based on 1989. You can see the unemployment went up to 7.5%, but the home sales will still keep going up regardless on that. And in 2000, the same concept was 6% unemployment went up, but we still had, geez, I mean, the whole thing was just keep going. And the only difference that you really see is in the chart number 3 over there, that when we had those crises in 2010, the 9.6% unemployment really kind of hit the market. And those home sales, they actually went down. But that's the next chart I wanted to kind of break down.
So yeah, that's exactly what I was going to comment on the last chart. And this puts it into a visual perfectly, is there's a lot of different things that go into, a lot of different factors that go into the real estate market. And just because unemployment's down doesn't necessarily mean that home sales are going to be down. There's a lot of different variables that go into that. And this is a perfect chart to show that.
Oh, I know. And I think it's really would it really cause that unemployment rate and the home sales, it was really mortgage availability. I mean, you can see how that plunged in 2008. And I think that really those two and two kind of together, you can put the mortgage availability was really the whole crisis. I mean, there's a lot of factors was back then, but you can really
I think that's a good point. I know that you've had a lot of conversations, and myself as well. A lot of people are asking, hey, is this another 2008? And this is a great graph to show you that we're in a very, very different time. In 2007, 2008, 2009, those were very easy times to get mortgages, which basically allowed everyone to over leverage themselves and put themselves in a financially difficult position, where now we're seeing that a lot better mortgages are being written, which is allowing for a much more stable real estate market. So do we expect to see a huge plummet in the next couple years? No, we don't, because the mortgages that are being written are much safer and stable mortgages. And then that is in turn creating a much more stable environment for all of real estate.
No, I agree with you 100% on that. And this one, just wanted to share, Conley, that what the economist believes that what the recovery would look like. And you can see, I mean, we've been talking probably for the past several, market update. The third quarter would be our kind of hopefully recovery quarter, and everybody still stick to that. And so hopefully that would be the case. We cannot predict the future, obviously, but we can see what happening, and and hopefully we can get there sooner than later, right?
Absolutely.
So this is was kind of fun survey, because I thought kind of to share is it's about impact on the savings, and the majority of the consumers, 63%, said yes, I'm saving more money. And you can see on the 12, unfortunately, still couldn't, and 25 is about the same. So I just thought it was kind of fun.
Well, yeah, this is actually a really interesting graph, and my wife and I were talking about it the other day. When you drive around, and this kind of shows this, when you drive around neighborhoods now, you're starting to see a lot of people doing high dollar renovations to their home. Maybe that's adding a pool or adding a fence or painting their home. Things, just from an observation, I feel like it's happening more now than it has in the past. And I think it's attributing to people are saving money, not going out, or possibly not paying daycare because their kids are at home. So they're taking that money and they're actually putting it into their homes to improve their homes. So that's going to help the overall market as well, kind of appreciate as time goes on. But it's an interesting chart to see, because me just driving around my neighborhood starts to see this, and this puts it into a visual to really identify that, hey, maybe this is the cause of that.
Yeah, and it's bringing a neighborhood value up as well. So it's not only a individual home improvement, but it's just the overall concept. And I think, as we move on further and further, hopefully it just will get better.
Yeah, and that's just gonna, as people are asking, hey, are home prices gonna go down? Well, all these things that we're talking about through here, there's multiple different factors that go into it, and they're all starting to indicate that home prices are not going down. Home prices are going to go up over especially the next couple of years, but even over the next 12 months, everything is indicating that they're going to continue to appreciate.
Oh, you will see with the local charts, because this one actually was kind of nationwide. This one just wanted to share so you can kind of understand where the market at. So if you have kind of less than 6 months, it's obviously seller's market. Between 6 to 7, it's kind of neutral, and 7 months and greater, that's our buyer's market. So that's kind of just to give you a breakdown on that. But this is our month supply. So since last time, we added actually Estero and Marco Island to the charts. And just wanted to share the months of supply. I mean, take a look. This one is the orange is 2019, the blue is 2020. Can you believe that last year for the July, we had 7.8 months of inventory. So it was definitely buyer's market, right? If you really think about it, because we just said that anything above 7. And now for the single family homes, we have 4.2 months of inventory. So the inventory is definitely totally, disappearing, which is, which is people have to understand, like, this is what's going on. And that's a 46% actually difference. The 19% difference for the condos between 2019 and 2020. And for Bonita, you can see the 32%, we have less inventory, and for the condos, 11% less inventory. And single family homes for the Estero, 42%, and condos 22%. So we definitely lost inventory throughout any of the cities. And the same concept you can see for the Marco Island as well. So it's just getting there. This one is the new listing. That's the one that people would put the properties on the market. And we compare again the 2019 to 2020. So there's 5% more people put single family homes, even though the supply of inventory way less, but the people actually put more homes on the market, and the 30% on the condos. The Bonita 14 and 65%. Wow, 65, that's a pretty big number. And the starter is single family home, and condo is 78%. There's more people put on the market, those condos, compared to the 2019, and Marco Island is 65%. So there's definitely more movement on the market, that's for sure.
Yeah.
And this one is the homes for sale. So this is like the homes currently was for sale for the months of July. And you can see for the Naples market, we actually have minus 43% compared to the 2019. And condos is 21%. So it's way more home lots for sale overall. If you look all of these numbers, 31%, 18% less homes in Bonita Springs, Estado, 39% to 23% less. I mean, it's a less homes. It's, you know, less choices for the buyers. So we just need to work harder to find the right opportunity. And this one, pending sale, can you believe this, Tyler? I'm serious. This is like insane.
It
I mean,
is.
it's like July, right? July is July. I mean, it's not changing the year. And we have 61% in pending sale increase for single family homes compared to July for 2019. I mean, this is like super exciting. I mean, when I see that, it's just like, wow. I mean, this is,
it shows the demand, right? It shows the demand in those areas. And there's just a massive demand right now as everybody, you know, kind of comes off of quarantine and starts to move around and travel a little bit more. You know, we're seeing a huge demand in this area.
Yeah, I think a lot of things to do with a lot of people would recognize that they've been stuck in that COVID-19 lockdown situation someplace else, maybe where it's cold, where it's like, I mean, Naples has a perfect weather. I mean, it's especially in the winter. I wouldn't say in July, but a lot of people would make this decision like, I don't want to spend another winter by not knowing what's going on with the COVID-19 and stuck someplace, maybe in that small apartment somewhere in New York, you know, and they just want to come over here and enjoy the sunshine. I mean, a lot of my customers, I spoke for the, who was stuck here, and they said, oh my gosh, it was like the best place to stop. Seriously, I actually closed on a condo at the dunes in 2019, December. So they were stuck all entire year. They're from New York, and they said, oh my gosh, it's like, it was like the best place to stop. I mean, it really is, but you can see all those numbers, it's just insane. The Bonita Springs, 101%. Can you believe this? 101%, 103% on the condos. This is the pending sales. Wow. And 70%, 47%. Look at this Marco, 124%. This is interesting.
Yep, absolutely.
So this one is the total sales. That's the closed months. And you can see the numbers again, they all up. 35%, 20% for the Naples, the 3% for Bonita, condos likely was -3. Single family homes in Estado actually was -5, -30 for the condos and the Marco Island as well. So that's kind of pretty much the numbers. I just thought it's just fun to share, and you know, if anyone that watching this would like to have, I mean, slides actually emailed to you, I'll be more than happy to provide to you the information. So let's talk about forbearance. I know we've been touching on that last time.
Yeah, absolutely. We touched on it a little bit last time. Actually, I think the last two updates we've provided, we've touched on it. And, you know, obviously forbearance is still around, and you can see by these numbers here, kind of going from May to July, you've seen that forbearance is going down, which is a great sign. Now, you know, things to think about is, you know, forbearance. One of the big things that we've seen in forbearance, and the numbers kind of ramp up so drastically. Yes, there are people that are unemployed, and that is unfortunate. But we also are seeing a lot of people that may be, you know, perfectly employed and doing well, that have opted for forbearance just to skip their payments for a couple months. And actually, we've seen a lot of applications for refinances and things like that, where these individuals may be perfectly employed, but go ahead and opt in for forbearance. And this was because of the way that the CARES Act was written, and there was no reason for to show that there was any hardship on that. So I think that these numbers are a little bit inflated, But with that being said, the trend is going down, which is a really, really good sign. And something that I believe if we kind of go to the next slide here, something that we talked about last time was there's a lot of different options to, if you're in forbearance and maybe you can't make your payments and foreclosures on the forefront, you can extend your forbearance period. So depending on your servicer, and you'll definitely have to talk to your servicer, you can extend your forbearance up to 360 days. So basically a year. But you can also modify your loan.
I know, it's crazy. A year. I mean, we never saw anything like that back in 2008. And I will tell you this, I just don't think the banks wants to see anymore the mess where we've been. I just don't think they want to see all those foreclosures, everything. They just don't want our homes anymore back. And, they just, I mean, I can, based on the situation, I can see how the government really trying to help the people, in this pandemic situation.
Yeah, absolutely. Absolutely. And something we talked about last update was, the people that, as a overall real estate market, we have a lot more equity in the marketplace than we have in the past, especially in that 2008, 2009 time, where most people have enough equity in their home where, let's say that they are facing foreclosure, the option to sell is definitely there. Where in the past it was they were 100% or 110% leveraged on their home, and to sell their home, they just can't make the payments. They won't break even. It'll cost them money to sell. Where in this situation, there's a ton of equity out in the marketplace, so they're able to sell their home and actually recoup some money from that equity, and maybe go purchase something smaller or go rent from there. So there's a lot of different options that are out there. So I'm not necessarily, again, we don't have a crystal ball, but I don't necessarily see the foreclosure rates that are going to increase to the levels that 2008, 2009 were. It's just not going to happen.
I just don't see, if the house, let's say, worth $500,000 in today's market, I just don't see the bank would foreclose and sell for 250. It doesn't make sense,
No. And it's, before the pandemic, we're seeing what, maybe 0.1 to 0.2% foreclosure rates or forbearance rates. Do I think that those are going to go up in the next 12 months? Yes. I think they could inch up, a couple tenths, but are we going to see 4 and 5 or 8% foreclosures? I don't think so. I don't think our environment is going to get there.
Yeah, and I think we said there was like 77% of all the homes, it has like at least 20% equity.
Yeah, absolutely. Absolutely.
20% equity, even you can do a lot of different things.
Exactly.
Let's talk about the purchase application. I know you've been taking this quite a bit lately, right?
Yeah, absolutely. So we've seen a huge increase in purchase applications, and you can kind of see in April and going into May, there was a huge lull in purchase applications. But then it came back strong. Everyone that was looking for homes and were in February, March, and then were kind of unsure what was going to happen, they all kind of put it on hold. And now we're just seeing all those come through. And obviously you can see in the graph, we're seeing huge volumes of purchase applications for mortgages. So it's a good sign that the market's coming back nice and strong.
Yeah, and it is a nationwide chart, so we didn't have a local one, but we just wanted to share what's happening in the entire country, for that matter of fact.
Yeah, and one of the big reasons is exactly this chart here. Rates, mortgage rates are incredibly low, and we'll get to it in a little bit, but it's allowing people to purchase homes that they're kind of their dream home, really. It's allowing them to do that. So you can see this chart where back in the 70s and 80s, rates were very, very high. I mean, could you imagine trying to buy a house right now with a 12% mortgage rate? It's incredible. That would be, oh man, it's so expensive. And then you see in 2010 where we're down at 4%, which is an incredible rate when someone's loaning you, hundreds of thousands of dollars. But now today, we're looking more in the threes. So here's a great example of that. So we're currently in the low threes for mortgage rates. This is a 30-year fixed rate mortgage. We're in the low threes. And you can kind of see these projections. It's projected that they're going to stay there for the next,
Or
couple
even
quarters.
go down. I mean, they do predict to even go a little bit down too.
Yeah, absolutely.
Tries to even see under 3%.
Definitely. And that's where, seeing this strong demand come back so rapidly, this is a huge contributor to that. When people possibly were pre-approved in the past for 100,000, or let's call it 300,000, but they wanted a $400,000 house, they can now buy it because rates are lower. And we are expecting rates to kind of trend down just a slightly more over the next couple quarters, and then kind of level off in 2021. Q1, Q2, Q3 of next year. But again, I would not wait. And I get this question a lot. I would not wait for rates to go down any lower, because if you look at this graph, how much room can it go up versus how much room can it go down? If you were going to place a bet on this and gamble on it, I would gamble that rates are going to go up before they go down considerably. So do we expect to see them a 30-year fixed rate mortgage down in the 2.5s? Probably not yet.
It's a lot of opportunity. Like, a lot of people try to make all the lines perfectly, but in reality, it's like I always say, like when people ask me, what is the best time to buy? I said, well, it's when you find that perfect opportunity and you get your terms and conditions and everything between lined up, because life is not perfect, and some people trying to catch the best perfect time, and a lot of them missed that 2010, 2011 when it was just crazy,
Yeah. And this is a great chart. So the 30-year mortgage rate, fixed rate mortgage versus the 10-year treasury, it follows it pretty closely. And actually, the 10-year treasury is something that I look at every single day. So I look at the 10-year treasury and on a daily basis to see where rates are going to basically go within the next day, 2 days, and kind of see how that's trending. Right now, the 10-year treasury is at around 55 to 54 basis points. Super low. These are historic lows. Again, how much lower can it go when, just a couple months ago, it was up at 1? Again, where do we want to hedge our bets? Do we think that it's going to go down to 0.3? We don't know, but there's a greater chance that it goes up to 0.1 than it goes to 0.3. So if you're thinking about buying or even selling, now's a great time to sell as well, because you can now go and maybe upgrade your home. You're in a 4% interest rate right now, which is a great interest rate. But let's say you can go and upgrade and get a better, bigger house and get a lower interest rate. I mean, it's just a fantastic time to be in the real estate market in general.
I know. And unfortunately, we don't have a crystal ball, so.
We don't, no.
That's the whole thing.
Yeah, and you can see how quickly it changes, right? Mm-hmm. So you can see here, I believe that's the beginning of 2019, we were up in the 5s and the 6s, the mortgage rates, right? So now in a year, we've kind of dropped back. What does that mean? Now everyone's predicting and saying that rates are going to stay low, but no one has a crystal ball. So they could go back up. So we could be back at, 4 and 5 in the next 12 months. We don't know. Now we're not expecting that to happen.
It's not that great if you really think about that.
Exactly.
It's just never been so low. I mean, this is just. Yeah.
But it's funny. It's funny you say that, because I get that question a lot. Where if we say, hey, your interest rate's going to be a 3.06 too, and they're like, oh well, can you get any lower? And it's like, I don't know. I mean, that's pretty low. That's a great rate. A 2.99 for a fixed rate, 30 years. That's a very, very good rate. So and same thing here. We're kind of, again, we're seeing them trending down. They're at historic lows. So just a good time to be in the buying in a buying position here.
It is.
And then, another thing that we kind of talk about as well is, I have this conversation with a lot of people actually, is, should I pay cash or should I not for a house? And that's obviously gets into your personal finances. But one of the big things is, if you're going to get a mortgage for 2.99, can you get a better rate of return with that cash somewhere else? If the answer is yes, maybe you'd contemplate getting a mortgage versus paying cash. And that's kind of the discussion that I have with a lot of clients. But yeah, I love this chart. This is a great chart. This really shows what these lower interest rates can do for people, and especially first-time home buyers. So this is, you kind of see, and it's highlighted in a diagonal pattern here, the same, roughly the same payment per month, and what your purchasing power is down at the bottom. So if we're at a 2.75 interest rate, you can buy a $500,000 house, with that same payment, as if you were at a 3.5% interest rate. That same payment would be for a $462,000 house. So you're getting almost a $40,000 spread, and your payment's about the same. This really emphasizes that point of the interest rates being so low allows you to get a lot more house.
It is. It is. No, this is incredible. And we have a couple, this is like 300,000, kind of similar charts. I've just decided to pick like 3 price category because we have a lot of, condo second owners, and those ones generally in that price category, 300, ish. And this one is just 1 million. And the 1 million is really short to you. My gosh, like $100,000 difference. That's incredible.
Yeah, and if you go back to the previous chart real quick, I'm not sure if you can, but showing that, so let's call the $500,000 house. That's a $2,000 monthly payment for principal and interest. Most rent around here is getting to that point, or above that point.
No, actually, I would say above that, because $500,000 house you can buy here. You can buy easily, 3-bedroom plus a den, 4 bedrooms. If you rent, your rent will be probably way, way, way higher. Yeah.
So imagine renting that same home for, let's call it 25 or 28 or maybe $3,000 a month for a $500,000 house. You can actually buy that house and pay less to live in it. So these are, when we start talking about that, where rents are a little bit inflated just because we've had everything's kind of appreciated over the last couple of years, but rents are very high, rates are low. So we're seeing a lot of those first-time home buyers getting into a fantastic opportunity to start purchasing. Or maybe it's, I've been thinking about getting a second home, but I'm not really sure because it's a little expensive. So I don't really want the second home. Now's a great time to buy that second home because it's as cheap as it's probably ever going to be.
Well, I'll tell you this. A lot of my clients who are not quite ready to retire yet, they purchasing the second home, and then I renting them out in season. Some of them I'm getting 6, 7, 8,000 a month easily, in your top season, January, February, March. So there's just so much opportunity where you can do with your home when you actually in Southwest Florida, because of the flexibility, and a lot of tourists would attract to come here and enjoy that couple winter months as well. So a lot of them enjoying half a part of the year and rent it out for maybe some couple months, some maybe 3 months, some 4 months. And you can have quite a bit expensive to pay with that cash flow as well.
Absolutely.
So that was pretty much it on the chart. So that was pretty exciting. So
yeah.
So really glad that we actually got together today, and we had that long weekend. So it's kind of a little bit past the first, but it's better, later than never.
Yep, but, absolutely. It's good, and the market's strong. I think all those numbers are trending in the right direction. So definitely excited to see how everything progresses over the next couple quarters here.
No, absolutely. Looking forward. And as always, if you guys have any questions, or if you like to get any property evaluation, or if you like, Zoom tour meetings, whatever the case is, we're here with Tyler to help. And there's anything that we can do to help real estate related questions to answer, or anything, just please don't hesitate. And if you're thinking somebody maybe in that forbearance kind of trouble situation, just please reach us out. We're just here to help. That's all we're trying to do. And just look forward to serving you in Southwest Florida. And our information will be listed below. And just looking forward to the next update. So stay safe, and God bless you. Bye-bye.
Thank you. Bye.
Bye.